Hey everyone, welcome back to the channel. I'm Doug, the retirement guy. Which new NASDAQ income ETF is better for retirement? We're going to talk about the two new funds, the Global X's EDGQ and JPMorgan's ROCQ. Both of these funds fairly new, so we're going to use the same exact time period for both of these to see which one's performing, which one's working the best, and go for who's got the best income, growth, total return, and the best for handling taxes. So grab your mug, find your best beverage, pour it in, sit back, relax, get ready for a great show today. Hey, before we go any farther, I got to do this disclaimer. The content of this information is for entertainment purposes only. It's not financial advice. If you need financial advice, always contact a financial advisor. Also, past performances do not guarantee future results. Hey, before I go any farther, if you haven't got one of your new mugs, the Retirement Made Easy, Living on Dividends, Doug the Retirement Guy mug, these things make great gifts. They're awesome to have. They support the channel so we can stay unbiased across the board. We don't take advertisers. We don't do anything for income. We just do this, sell a few mugs, help cover the cost of making these videos, and we move on. If you want to support the channel, you can use the QR code or you can use the link down below. Also, don't forget about our new 40-ounce travelers. And I'll tell you what, guys, you guys are phenomenal because we put these in, got them in, and immediately they sold out. We reordered in again, and that batch is almost sold out as well. So don't be afraid. Get your stuff ordered now, and we'll try to get them shipped out the next day. So let me give you the comparisons of these two funds, what I did. As I told you, the historical period is going to be March 19th of 2026 through July 15th of 2026. So about 4 months exact dating onto this. The data basis, it's comparison utilizing the closed market prices and assuming eligible distributions are taken in as cash. And the methodology is distributions are counted based on the buyer's entitlement at the start of the period. No reinvestment is assumed. So the opening question that I have, these two newly large NASDAQ ETFs seek to bridge the gap for retirees. They're combining the participation in large cap growth with predictable portfolio income. Global X comes in with the NASDAQ 100 Edge package. It's a weekly distributions. Now, I normally don't cover weeklies on this channel, but this was something unique we had to talk about. These are weekly distributions aligned to recurring cash flow needs. It's targeting. Now, remember what targeting means. It means they're shooting. It's like a dartboard. They're throwing to try to get approximately 13% return. So they're going to do whatever they can to try to hit their target. Now, it's structurally built around the NASDAQ 100 exposure by writing partial call writing. Now, JPMorgan, this is new to them, but using, I'll call an old technology. ROCQ uses monthly distributions. Okay. Their strategy is an active stock selection, managed call option spread overlay. Okay, so they're not going to take, and they're looking for the fund to actively grow and doing overlaid option calls on that portfolio. The current yield and capital appreciation and reduced volatility is their goal of the whole package. Now, in that fair setup, as I just said, we just went through this. I said the observation is going to be March 19th. I do this again for anyone who missed that last screen, but because we get so many comments about this. March 19th of 2026 to July 15th of 2026. I chose those dates because that is actually the running date of ROCQ. So we're doing about 4 months approximately. And we're trying to look at the price basis, the distribution handling, and the entitlement counts on all distributions to a buyer's potential. So we know this is going to be limited cycle. It's going to be short term, but we're going to see how these things have done so far. So how did Edge generate income as an investment mechanics? Well, to get that targeted 13% that we talk about and that weekly cash flow as distributions, they write a partial cover call overwrite. Now, when I say partial, this is one of the unique things that Global X is doing. is they will only use a portion of their portfolio. And I call it the 25-75 rule. 25% to 75% of their portfolio will be covered or uncovered at any particular times of the period. It's going by what's happening in the marketplaces around. The dynamic management, Global X actively adjusts call option exposures to maintain that targeted yield while navigating the market volatility. So I'm going to put it in layman's terms on this one. If they're looking at the market is growing, things are taking off, doing well, they're going to go down to that 25% category for a while. Now, if the market starts getting volatile, starts bouncing around, going up, down type application, that's volatility, they're going to open up bigger to try to gather more income. So they may be gathering more income this week, less next week, and vice versa. Now, ROC does it different. ROCQ does it differently. JPMorgan uses their proprietary research and advanced data science that chooses the stocks that they're selecting. The portfolio consists of NASDAQ-listed companies chosen for fundamental quality and growth potential. It's not strictly tied to the NASDAQ 100, though. They're not tying it right down to that. They get to use the index weights, allows for active security positioning. Now, they're using a managed call option spread. The call options are collected immediately, the premium income for distributions to the shareholders. They buy calls at strike prices to potentially regain upside potential during sharp market rallies. So understand that one. That buys calls at higher strike prices. It buys someone else's NASDAQ 100 call option to help in the participation in sharp market rallies. That's how they control their capping of their portfolios. So their flexibility and their structure is designed to provide reduced volatility and relative pure NASDAQ exposure. So between these two strategies, I always call it one's very transparent and one is actively flexible. So the simplicity and the transparency of the Global X fund is I can explain it very easily and very well that they 25-75. And they're just moving that needle around and trying to make sure they can hit that 13%. So they have a target to shoot for. They have a plan on how to get there. Simple, transparent. JPMorgan, a little more difficult, okay? It's an active structural flexibility. Now, they use this in JPQ. It's almost identical to JPQ, okay? But with tax management focus. That's the one thing JPQ missed out on. But now they're coming out with funds. They're going to be tax management focused. So they use that call option spread overlay. They can buy farther out to help increase their participation in the rallies. So they're always looking at how can I grow the fund? How can I do things differently by using every option opportunity to them. So what does that really mean in numbers? Well, let's take a look at this one. The actual cash distribution and yields. So in the period we're talking about, Global X came in at 4.64% period yield, while ROCQ, JPMorgan, came in at 3.38. Now, percentages are always a tricky number, and I tell you guys this all the time. They're a mathematical number. So if the price of a share goes up, the yield will go down. And if the price of a share goes down, the yield will go up. If they pay more money, the yield will go up or down based off the price of the share. So it all comes into it's a numbers game. So Global X looks like the winner at collecting 4.64% during this 4-week period or 4-month period versus the 3.38. Now, if you take this out long term, taking it basically figuring out that the dividends all stay the same, the income comes in the same, there's a big difference, about a 4% difference between the two funds 12 months out. So in this game, I'm going to say EDGQ, Global X, is going to win the yield game. But there is something I want to talk to you a little about. Look at the price, total cash, $1.14 for Global X, $1.68 for JPMorgan. Okay. Look at the pricing, $24 versus $49. The price of JPMorgan is almost 2 times the price of Edge. So I could almost buy 2 shares for every 1 share of JPMorgan, which means I would have $2.28 of income for the same investment to $1.68. So bottom line, Global X wins the cash flow. Now let's look at growth. Same exact periods, okay? The growth of Global X, 12.75%. The growth of JP Morgan, 13.05%. So we're talking about a 0.3. So, just a hair over 25% increase on the two, or 0.25%. But you're seeing the price is definitely growing from $24 to $27, from $49 to $56. So the advantage actually goes to the growth side, goes to JP Morgan. So their system of buying those farther out funds in the past 4 months has worked well for them because we've had a strong market. Now we're going to talk total returns though. When we take a look at the price growth and the cash yield, well, both of them won. Global X won the yield. JP Morgan won the growth. Total returns 17.39 versus 16.43. Now, that's a 0.96 difference, basically just shy of 1%. $96 difference between the two. Do I say that Global X wins? Well, if we're just downright, yeah, it wins. It grows a little bit more money. Is $96 a big enough number to make the difference between the two? Can't really argue that. I can't really say this is better or one's worse in the 4-month periods that we're seeing this. But there is a slight edge, EDGQ, their edge package is a little bit of an edge over the top when we look at total returns. Taxes. I'm going to put it to you guys this way. I'm going to flip a coin and you guys answer the question. Which one's better in taxes? Well, they both basically use a return of capital. And I think both companies use it properly in this particular fund. Okay. Now, these numbers don't mean nothing to me until I get my 1099 DIV form at the end of the year. You can go through and tell me that you're 99%, you're 100% all year long. And if I don't get that report, that means somewhere down the line you made a change, you didn't tell me about it, and it comes into it and says, hey, here's your difference. So both funds are saying, 99, the fiscal year down 94, JP Morgan's 96. So I'm just telling you right now, I'm going to throw both of these up in the air. What lands either side of the coin you received or you called, you won. Because I think both of these guys win-win in this situation. That's if you're in a brokerage fund. If you're in an IRA or Roth IRA, this doesn't really matter a whole heck of a lot to you because you're following the rules of the IRA versus what these guys do here. Expenses. Now, expenses are a whole different game. This is if you're going to hold this long period of time. Most people get expenses, they get it wrong. They don't understand. It's just another number they can look at and say, oh, you're very expensive. But it's these numbers here, expense ratios are designed for holding this long periods of time. I'm talking a year, 2 years, 10 years down the road. Right now, Global X is offering a 0%, trying to grow their assets under management. Okay, so they're giving a 0% net ratio. When it's done, March 1st of 2027, they're going to go to 0.53%. JP Morgan, long term, is going to be 0.35%. So their savings is JP Morgan is savings because of the percentage difference, about 0.2% difference between the two. So for long-term holdings, JP Morgan's going to win with a lower expense ratio. Now here comes the biggest point that I can give you right now. So far, I think these funds are almost apple for apple right down the track. One's got a little higher yield, one's got a little better growth. Total returns are about the same, taxes about the same, expense ratios okay, a little bit to JP Morgan. But guys, here's where I come back with, and some of you have disagreed with me, some of you have proved this. I always say this. $50 million is the magic point that makes any type of fund almost safe in liquidity. They're not going to liquidate it. They get the $50 million. The company's making money. They got plenty of money to operate with. There's not a lot of worries they have to do. These guys sit here and say at 50 million is the number. Now, most companies will tell you 30 million, they're making money, but overall 50 is that magic number. Global X, even with that 0% waiving all the way through, was able to collect $8.3 million in assets under management versus $315 million from JPMorgan. This is a drag race that the one car never even left the line. So JPMorgan's ROCQ already well over the 50 million, very comfortable with it, very strong, going to be here long term, all the way through. Global X needs help. They need some money. They need to grow their funds. I'm not saying they're not growing. I'm just saying they need to get closer to that 50 million before I really feel comfortable investing in this type of fund. So here's my scorecard. JP Morgan's going to win with that strategy flexibility. Okay, so they're going to be able to reach in tough markets, control things in bad markets. Current yield went to Global X. Share price growth went to JP Morgan. Cash total return, Global X. Tax management design, I tell you it's a flip up. I know I have it as winner. I think the realistic my computer program would come back and spit out and say because of the 2% difference in the ROC. I think it's a trade-off. Fund size though, God, JP Morgan's crushing it. It's the winner all the way through. And the temporary fee waiver, well, I'm looking at this. If you're holding long-term, then there's a different winner. Short-term today, yes, Global X wins. So where do I put these funds? I still say it. You can put the JP Morgan in either fund, taxable account or an IRA. Edge is, you can do it both ways again too. But a lot of people say I like in the IRA for the income potential across the board. My final verdict though, I'm going to put it to you this way. Even with an asterisk I have to put on this. I think over this period of time, Global X is winning. Yes, they don't have the assets under management as much as I want. That's why I'm not into it. That's why I'm holding back. I'm not going to have FOMO. I'm not going to have fear of missing out. Let it go. Let it show me that its assets under management is growing. And since putting this video out, we can always take a look at it. It probably has grown. But overall, Global X is the winner. 17.39% cash total return during this period, this 4-month period. It's doing everything that it says it's due. I give my hat off to Global X for doing a great job. I'm going to step up and say, JP Morgan, don't feel bad. You guys are doing a great job too. I just have to give the edge because of the way I do it is the total return number looks better on Global X, better income. It has a decent amount of growth as a market control. Guys, let me know what your thoughts are. Do you think JP Morgan's better? Do you think Global X is better? Do you like my $50 million or not my $50 million? It's a number I've used for years now to make sure that I'm buying quality, safe investments. Hey, before we go anywhere, don't forget we are a 40-ounce travel mug. They've been selling great, guys. It just helps the channel. I'm not trying to be a promoter. I'm not trying to sell things anymore. Just look at, everyone needs support. Everyone needs help, and this is how we do it. We introduced a new 40-ounce travel mug because actually someone asked 2 reasons. One, I'm embarrassed by because I went out to my truck and I dropped my coffee mug, shared it on the driveway, and I said we got to do something different. So I wanted a travel mug. And then I had someone also say onto their comments, man, you got to get a travel mugs. I'd love to see something 25 or bigger. We got you the 40-ouncer. If you see anything that you'd love to have our logo on, let me know. I'd be more than happy to produce it for you, get it done. Everything helps support the channel. Thank you so much.